Before you start comparing suburbs or chatting with lenders, there's one thing that you really need to do before jumping into an investment property, and that is to run the numbers. A property might seem like a really good idea in your head, but until you understand the impact that it's going to have on your cash flow, your tax, your net asset position, well, you're really flying blind. That's why I have built a free calculator specifically designed for Australian investors. It's going to show you everything from the growth of equity to when the property is first positively geared. And best of all, it's really simple to use. So in this video, I'm going to show you exactly how it works. We're going to do a bit of a dummy case. I'm going to show you some of the key outputs and the really primary metrics that you need to be considering. So when you do go into your next investment property purchase, well, you do so with a really clear idea in your head. I'll put a link to the calculator in the description box below. And again, it is free to use. You don't even need to put in an email, nothing. Just jump on there and start punching away the numbers. All right, so jumping on the website, here is the investment property projection tool. So if we scroll down on the left-hand side here, we can start inputting our details, and then we're going to get our outputs on the right-hand side. So I'm just going to run through a little bit of a dummy case. So let's say we're buying an investment property worth $1 million. We're going to assume a pretty modest growth rate on that of 3%. We're going to assume that we borrow $800,000 to fund the property. Interest rate, let's go 6%. Now, you can choose if you want to leave it interest only or if you want to do principal and interest repayments. So let's go no. Let's assume we're doing 6% over a 30-year loan term. Keep the repayment frequency as monthly. It's going to automatically calculate what the minimum P&I repayments are. But let's say I'm going to put $5,000 towards it. So you can actually change it to suit your needs as well. Now, there's room and scope to do a second loan. So the reason why we wanted to build this in is because a lot of property investors will borrow their initial deposit against the equity in their own home and then borrow the remainder against, say, the investment property itself to avoid cross-collateralizing. So you have the option to be able to factor that in as well. Gross rent, I'm going to get $700 per week from my property, and I'm going to assume that that goes up by 3% per year. I think it's going to cost me, well, with property, my standard sort of assumption is normally around 25% of the rental income, depending on where the property is and the type of property, of course. So I'm going to go that my rental expenses are $9,000 per year. So that obviously excludes the loan repayments. Now, in terms of that $9,000 is going to increase by 3% as well. We're going to assume we've got depreciation to claim on the property. So this is a non-cash item of $5,000 per year. And I'm going to assume I'm on the top marginal tax bracket. Now, you can do the projection duration for up to 50 years, but I'm just going to leave it as 30 years. So when you're happy with your inputs, you hit this calculate button. And you're going to get your results over to the right here. So what you can see is in this graph, it breaks down a number of the key elements. So the property value is there. You can see basically it starts at $1 million and it goes up by 3%, our estimated growth rate. The light blue bars are the gross rental income that we're getting. Again, that's increasing by our estimated rent growth rate. We've got the loan and we're doing P&I repayments. So the loan balance is going down. That's the gray behind the scenes. And then we've got the holding costs. So you can basically see that when the loan keeps reducing, eventually interest is gone. And then you start the expenses just continue to increase because we've assumed that it's $9,000 plus 3%. Those expenses also include those loan repayments. Now, there's this little slider where you can slide to the particular year that you want to see what's happening. But it defaults to year one. So let's start at year one. Now, a few of the key metrics are here. So in year one, money made is like your summary. It basically says, well, how much money have you made from that property, taking into consideration the rent you've received, the growth you've received from the property, less all of the costs to hold that property. So you can see in year one, we made $21,610 in our property. Here are the other key metrics, and you've got cumulative, so that as you continue to slide across, you can see the cumulative value of money made every single year as well. Some of the key metrics include, so we've got the equity at the end of the year. Obviously, when all of these key metrics, just run your mouse over these little information buttons. It's going to explain exactly what every metric is. And I'm not going to go over all of them in detail. I'm just going to go over a few ones. Equity is how much of the property you own, essentially. So the value of the property minus the debt. One that I really like is this cash flow pre-tax. So when you're going into an investment property purchase, you have to be careful that you're comfortable with what it's going to cost you from a cash flow perspective. And there's two. There's cash flow pre-tax, so without factoring in any tax deductions or tax payable. And then there's cash flow after tax. So where it's a negatively geared property, it's going to cost you money to hold the property, but then you are going to get some tax back. And so it's the cash flow after tax is going to be a little bit easier given that you've got that tax benefit of the property. So for me, these figures are really key. The cash flow figures are really key when you're considering investment property purchases. You need to ensure that you can fund it from the cash flow pre-tax, knowing that you're going to get a bit of a tax benefit, and then the cash flow after tax is going to be easier, but you probably won't realize that cash flow after tax until after you lodge your tax return. So they're key figures. You've obviously got LVR, capital growth to offset net loss. So basically, if it is a negatively geared property, well, it's costing you money to hold that property. So how much capital growth do you need from that property in order to be able to make it a viable investment? And in this instance, it's saying it's 0.8%. Down the bottom here, we have the usual things. So property value starts at $1 million in year one. We assume the 3% growth rate. So by the end of the year, it should be worth $1,030,000, so on and so forth. Loan details, again, we can see the breakdown of interest, principal, the ending loan balance. In terms of income and expenses, we've got the gross rental yield, the rental expenses in there. We've got the depreciation, which is a non-cash item. And then we've got the total holding costs excluding depreciation, which also factors in the loan details. So you can, again, have a look over the different years, how it's going to play out over time in terms of how it's going to impact your cash flow, how it's going to impact your asset position. This little line here in the graph is actually very handy. So this will, based on these assumptions, it shows you when the property is, the first year the property is positively geared. So in this scenario, in year 14, then that's when the property is going to turn from a negatively geared property into a positively geared property. So it's a pretty cool little calculator. Have a play with it, put some numbers in, and if you have any suggestions about ways it can be improved or changed, then feel free to leave a comment in the description box below.